Hi, everybody. This is Kevin, a CPA that does financial planning, AKA now the professor. So I'm going to talk today about when stock markets are going down, and that's in quotes, are going down. So what can we learn from this? You know, the teacher shows up when the students are ready. So when we make the statement, markets are going down, Your Money, Your Brain, Jason Zweig from the Wall Street Journal wrote a great book about when we see three dots, the fourth dot comes along automatically in our brain. We see going down, going up. We are pattern recognizers. And the reason why we are is because the people that were not pattern recognizers in our history are all extinct. So pattern recognizers have survived. But with investing, pattern recognition about, three dots going down, that doesn't mean the fourth dot is going down. So anyway, markets going down. Let's replace that with markets have gone down. So let me just divert to efficient market hypothesis. All it means is that today's prices are based on today and yesterday's information. That's it. It's everyone around the world investing, you, me, mutual fund companies, all different types of investment companies, endowments. Everyone is investing, and we create the price. If we think the price is too high, we sell. If we think the price is too low, we buy. It's the best guess at prices. It's not the right price. The market price today is based on the fact that we are worried about the Fed. We're worried about shadow banking. We're worried about China. We're worried about Russia. We're worried about this, that, the other thing. That is all part of the reason why prices have gone down in the past couple weeks. But it doesn't mean that the prices are right. They could continue to go down if new information comes out tomorrow that makes people say, yeah. So I think another example of this is that inflation is super hot, okay? So 2 weeks ago, including me, a lot of fear about inflation. So markets are down, and I'll share a video that I made back in 2020 during the dark days of Corona. And this was real-time live, and I was pretty despondent and upset and worried that markets would continue down. And I'll just say I'm glad we didn't do anything at the time. Next thing, stock markets do go down almost every year. Okay, this is, and I don't know why we can't remember this. We can't. I mean, I show this to people, and they're like, wow. And then we show it to each other, we're like, wow. Markets are down on average 14% in a given year. That's average, okay? Some years it's down a lot more. Some years it's up a lot more. About 2/3 of the time markets have finished up. No guarantee they will. There's that 1/3 of the time. But volatility is what higher returns, they go together. Volatility is what causes expected returns to go up. Because if I have a business and I want money from you, okay? You're going to first say to me, well, how safe is my investment? Well, this investment is super safe because X, Y, Z. And then if you don't want to give me the money, I can get some money from somewhere else because the investment is super safe. Or this investment is super risky. You're going to say, I want a huge return if I'm going to give you this money because I might lose it. So volatility and returns, they go together, although that's very painful to hear. The next point that we can learn from is that diversification, okay? So in really short periods of time when there's market stress, sometimes it seems like diversification does not help because they say, and this is true, that all correlations go to 1, which means that maybe all investments go down at the same time. Right now this year, we have bonds down about 2%, and we have stocks, as I said, US stock market down about 7%. So why didn't they help? Well, it's kind of interesting. The last couple of days, bonds have started to go back up again because there seemed like there was some panic in the stock markets. So longer periods of time, though, this is what I think the key for diversification is, okay? So I go through a couple months, my investments are down, and then I look at my investments and say, I think I need to sell. And we try to figure out what are the arguments for holding. So one of the arguments to hold a really diversified portfolio, a worldwide portfolio, that as long as the world does not go bankrupt, we should hold, right? If you own 3 companies, they're all high-tech companies, and there are some of those companies that are down 40%. There is a real risk that these companies could go bankrupt or they could go to zero and be gone. So holding a really diversified portfolio at least gives us some strength to know that those portfolios, unlikely to ever go to zero. So the next point I want to talk about is predictions of the apocalypse. So, it's really interesting to me that someone will retire, something negative will happen in someone's life, and immediately they start sending stuff and wanting to talk about the apocalypse that's coming. And there could be an apocalypse, always. I mean, that's always a risk. But what ends up happening is that this apocalyptic information is out there all the time. I promise you. You go on any website today, you'll see stock market crash. The next apocalypse is coming. You'll see it every single day. But people will notice it once markets are down a bit. And we get more scared after markets have gone down. There's no doubt about it. When every day there's something about you may have disease X or Y. Somebody we know has disease X or Y. We blow it off. And then we're not feeling well one day and we start to have some, strange things happen in our physical health. And then we immediately say, do I have that? And then so it hits our reticular activating system in our brain and the antenna goes up and says, uh-oh. So that's what happens with the predictions of the apocalypse. What I would suggest is to think probability versus making predictions. So be humble. This year I have no idea what's going to happen this year. Because people will say this year, due to the Fed, Russia, trade war, Europe, North Korea, China, coronavirus, Ebola, Democrats, Republicans, Fox Media, CNN, them, us, all during all of these different things that happened, World War II, Vietnam, there was always predictions that stock markets would be gone. So this idea of experts. So experts will tell you what to do. On the way up, everyone is an expert. On the way down, people will start to say, hey, you got to get out of this market. You got to avoid the market crash. So I guess I would ask you, why? Why do we have to avoid the market crash? Well, that seems like a stupid question to ask, Kevin. Why would you ask me why I don't want to lose money? Well, so that's making the assumption that we can predict when to get out and when to get back in. I'm going to share with you at the end of this live when I was in my car back on March 17th when the market was going down. I think it was down about 32% at the time, 30% at the time. I was pretty despondent, somewhat horrified, but I was telling the camera and I was telling myself that this is what we do. This is what we're going to do. This is the value of the belief that we have. And, thank the Lord, we didn't sell everything at that time because, look at what happened after that time period with this graph here. I mean, wow. And then I guess the next question I would have for you is avoiding the corona crash. How did that help you? If you avoided it, did it help you? Do you even think about 2020 stock market performance anymore? So sometimes the mission we think is to avoid short-term losses. The mission is to grow our wealth over long periods of time. At least that's what I think the mission is for those investment dollars that are for the future. The second thing that I think we don't know that we're doing is when markets are going down, again, poor language, we say, let's get back out. Let's get out and let's get back in again once it bottoms. There is no bell that rings when markets bottom. There's absolutely no bell that rings. There's no lighting up on our computer screen that says, this is the bottom. So we sell today, all right? And tomorrow we come back in again. And what happens if the stock market continues down? We don't buy. What happens if the stock market goes up? We say, well, it's probably going to go right back down again. Then it goes up a few days. And the biggest days in the market upward come after the biggest days in the market downward many times, not always. Again, we can't make predictions. But what if the market goes up 3%? Then do we get back in? Okay, we get back in. All right, I agree with that. Then the market rolls back over again and starts going down again. And you can just see the insanity here. The insanity. So if you remember these crashes, what I can tell you, what I remember is the people most of the people at least called us and said, hey, should we do something? And Jack Bogle famously says, don't just do something, just stand there. Instead of don't just stand there, do something. He always said, don't do something, just stand there. And that is the hardest thing to do. But as you can see from this slide, the average investor vastly underperforms their investment. And this, this idea that if markets will be higher, and this is a probabilistic thinking point here, is that if markets will be higher in the future, we do want to just stand there. So if you don't think markets will ever be higher in the future, 10 years from now, 5 years from now, whatever your time zone is, then don't invest in markets in the first place, because you're just going to be ripe with disappointment. So one of the things that Rob and Charlie and Ben said on their podcast recently, and I thought it was just terribly interesting, is they were talking about where to get your information from. And Rob said he likes to get his information from books. So, they were kind of talking about where do you get your information from on the internet or TV. And he said, nah, forget all that. Read books. And that is what I've done over the years. The little book of Common Sense Investing from Jack Bogle. Any book, Bill Bernstein, who was a neurologist who became an investment author, the 4 pillars being, I think, the best of them. There's lots of books out there on investment theory. If it involves market timing, stock selection, technical analysis, don't buy the book. If it involves all the history of data and how to interpret it, and that sounds really boring, but again, if you want to be an investor, you either hire somebody and understand how they do it, or you do it yourself. I mean, those are the only choices. In the 4 pillars of investing, William Bernstein says you got to understand these 4 things. If you don't understand these 4 things, don't invest. So what are the real fears to have, in my humble opinion? The first fear to have is chasing hot money on the way up. So, ARK investing, I started hearing a tremendous amount of ARKK back in, I think it was 2020. Number of people said, why aren't we in this? This lady is investing in the future technology. It's incredible. Then I started feeling like, man, we're missing out on this. I feel stupid for not investing in this. The Qs somewhat is I guess the hot money fund that I have personally put my own money in. It's still all the companies in the NASDAQ that are profitable. Tesla is mildly profitable, so that's a little bit of hot money, and that's been off 12% so far this year. But chasing hot money on the way up, this money can disappear. This is what happened with the tech.com bubble. And, the same people that say, hey, the tech.com bubble was stupid are ones that are recommending investing in really highly unprofitable companies right now. So I don't know if this is going to be a bubble or not, but I do know is in every market cycle, when there's hot money on the way up and people are jumping in to make a quick buck, many times on the way down, those quick buck people want to get out before they get destroyed. Their thinking is like short term. And so chasing hot money on the way up is always bad. So not being diversified. So you have this thing called systematic risk versus non-systematic or unsystematic risk. And I'll show a chart here. Now, all stocks have systematic risk. It cannot be diversified away. So if markets go down 20% and you own the market, you're down 20%. But there's many risks that you could diversify away, like owning an individual company, owning only companies in an individual country. These are risks that if you diversified and owned, pretty much a little of everything, and the world does not go bankrupt, and you own the future winners because they go into your investment, so you're still going to have systematic risk. There's just nothing to do about that. But the more you diversify and the more boring your portfolio is, if you're fully diversified, at least you only have the risk of the market. So the next thing is if you need to use the money now, next year, soon, that's something I would be very afraid of. So I need money now. I'm going to buy a house next year. It's all in stocks. Probably a bad decision. All I'm saying is that if the market does go down and you have $100,000 in stocks and the market goes down 40% and you're going to buy a house with it next year, that's not matching your time with your investment. The mission is to have money available when you need it. It's to have money at your fingertips when you need it. And so if you need that money in the next year and it's in stocks, that might be a mistake. And that is a very reasonable fear to have. So the next reasonable fear, and the final one I have here, which I think is very reasonable, is anytime you decide to sell and get out and go to cash and not being able to get back in. I've seen it so many times with people that have come to us and said, hey, I want to invest with you. I'm all in cash. And I'm like, well, what happened? And they're like, well, I got spooked. And I feel the same way. I've been spooked before in my evolution. I've gotten out of markets in the past and then regretted it, because when do you get back in? And so they say, what do you think? Should we get back in? And I'm like, yeah, let's get back in. Maybe not go 100% stocks though. Let's go 60% stocks. And they're like, well, I don't want to own bonds. Well, let's go 50% stocks and keep the rest in cash. Well, cash is not, and you see where I'm going here. And so in 2011, 12, 13, 14, 15, 16, all the way through now, we've had people come to us and say, I have cash. I went to cash. What should I do? We always make the same recommendation. Let's make an allocation. Some will say, I'm not getting back in now. Are you crazy? And so this whole idea of selling anytime, the hard part is getting back in. I mean, that's really, really hard. That's something I fear. I personally fear it. That's what keeps me in markets as they go down or as they have gone down. That's what keeps me in markets. I know if I sell, I'm screwed. So anyway, here's the top 7 things of what you may consider doing now. So I think deciding that right now, as markets are down 7%, U.S. stock market is what are you going to do? People will often again ask us, hey, if the markets go down, what are you going to do? What are you going to do for me? And we say, we're going to hold on. We know what we're going to do. Now, it's still very stressful for all of us, believe me. So it might be time to look at your diversification or lack thereof. There's lots of free online tools to look at your diversification. Try to focus on when you need the money. If you don't actually have a financial plan, make just a simple timeline of 2022 to 2060. Just make a very, very simple. You can do it by decade and say, when am I going to need this money? If you're 30 years old and you're super worried about a market crash, show yourself that you're not going to be needing that money if it's for retirement for a long time. And dwell on that as opposed to dwelling on the short run, because the short-term performance is absolutely the enemy of long-term returns. There's no doubt in my mind. Okay, so then the next one is know that there is never a perfect allocation, except in retrospect, known as the 2020 effect or the hindsight bias. There's never a perfect allocation. Cut yourself a break. If your allocation is pretty doggone good, again, back to William Bernstein, author, he says, I don't really care what your allocation is. Don't change your mind just because assets look terrible. Talk to someone who is knowledgeable about both investment theory and practice. Don't talk, if anyone ever tells you how well they did on an individual stock and that you should buy it too, thank them kindly for their advice, and then talk to someone who understands academic investment theory, not selling annuities, understands, the boring efficient market hypothesis, knows who Fama French is and other Nobel Prize winners. Warren Buffett is a great example of someone who studied investment theory and practice. And he's underperformed markets for a number of years. I think this year he's back ahead of the S&P 500 for the last 10 years. But someone that's really studied it and says to you, don't rush into anything today. You don't have to do this today. And then finally, my last one is buy a book and turn off the TV or the Twitter feed. And you can use Audible. So turn off the TV, the Twitter feed, whatever other social media that jacks you up. So anyway, we're happy to be on the journey with those of you that work with us. For those that don't work with us, please feel free to reach out, ask questions. Feel free to challenge any of the information on this video, at least in a civil way. And You know, I don't know exactly the best way to do things either. None of us do. Nobody knows what's going to happen in the future. But there are some things I think we can do. There are some strategies that we can implement. There are some people that we can rely on what's happened in history to make some probabilistic action steps now to make sure that we have the money in the future that we need. Thanks so much for watching. And I'm going to link now to how I felt back March 17th, 2020, when I was extremely despondent. Thanks.
Emergency stimulus to address the economic cost of COVID-19.
Hey everybody, this is Kevin. It's March 17th. It's St. Patty's Day. I guess I shouldn't have worn orange today. That's probably against the rules. But I love my Irish brethren. I'm half Irish, Scottish, and half Italian. So today we're going to talk about the coronavirus, the market crash, and just document the feeling today that we have, that our clients have, that Charlie and I have. Charlie and I still believe the best thing to do right now is to stay the course. It's getting harder to do that. The market's just going down. Yesterday was Bloody Monday, down 12, 13%. We're standing tight. We're standing steady. We think we know that crash has happened and the best thing to do is to do nothing, but in the last 24 hours in particular, we're getting lots of questions such as, why don't we just get out now and then get back in later? And boy, it sounds really good to get out while the market is quote unquote going down. And so I just wanted to document this. S&P is now down 30%. Small caps are down nearly 40%, 35% maybe. I don't know the exact numbers. But foreign stocks are all over the board, but they are down almost as much, sometimes more than the S&P 500. And we believe in staying the course. And so I probably will send this out to people in the future when they come on with us and say, look, this is what it's like to be a stock investor. Now, you don't have to have 100% stock, and this is the reason why you have some bonds, because there will be days like this. But if you're going to own stocks, you absolutely, and I'm going to use the word should here, but maybe the word should is wrong. You absolutely need to be ready to go through market downturns like 30% in about 30 days. You need to be prepared for this, and it's not fun. The problem is not that it's down 30%, by the way. The problem right now as we sit is we don't know how much more markets will be down, and that's really the part of market corrections, bear markets, crashes, whatever you want to call it, is that it's not just how much you're down, it's that now your money has been cut in by whatever, and you're afraid that you're going to quote unquote lose more.